Hello traders, Gary Wagner here, just after 11 o'clock in Honolulu, 5 o'clock in New York. It is Wednesday, 20th day of September, 2017, and this is the Daily Report for Gold and Silver. The Fed speaks and gold trades off strongly, closing off about $6.10 to close at $13.0450, and that is basis December's most active contract, which hit an intraday low today of $1,300 per ounce. Silver also down, but only down about 6 cents to close at $17.21, and that all in light of a strong U.S. dollar trading up almost 0.7% at 92.21. Of course, that did affect our trade, and we were in fact stopped out. I will discuss that in detail as we pull up our first chart. Traders, following the conclusion of this month's FOMC meeting and an announcement by the Fed that there would in fact be yet another rate hike this year, along with a start date of October for their massive liquidation of their asset sheet, we did see gold fall and fall pretty strong, currently trading at $13.0330, putting it down $7.30. It has broken through what was support at approximately $13.10. We did take a stab at the market yesterday, but if you recall, we put a very, very tight stop in the market. So if in fact this occurred, we would get out unscathed with a very small loss, the loss being $9 per ounce or $900 per contract. We entered the trade at $13.15. We got stopped out at $13.06 for a loss of $9. Now, the real question is whether or not today's action has caused major chart damage, because we have been in a bullish mode in the marketplace really throughout the year, but especially since July 10th of this year, when the market did come down and bottomed at roughly 1,200, and then we had a series of rallies and corrections. The first rally, of course, took us roughly to 1,280, a very shallow correction, 23%, taking it back down to approximately 1,260, and then a dynamic rally which contained over a $100 move, resulting in the market moving from 1,263. Now, that brings us to our current activity, in which we have been deeply ingrained in this current sell-off, and although I have been absolutely wrong in anticipating that 50% would be the conclusion point, we are now at a 61% retracement, which is roughly $1,300 per ounce, and a 61.8% retracement is still within the confines of a bullish model. In fact, to negate this model, we would have to see gold prices move not only below 1,300, but break below a 78% retracement, which sits at 1,281. Although 78% is an unusually deep retracement, it still falls within the confines of a bullish model, although many, including myself, believe that it should never really exceed a 61.8% retracement. And traders, that is precisely where we currently are. And so traders, based upon our current studies, the fact of the matter is, yes, it did break through a 50% retracement point. It has had an intraday low today of precisely a 61% retracement, and the real question becomes whether or not gold prices will find some sort of support in this area and begin to bounce off of that, or if it in fact will track lower down to 78. If in fact this is a point in which this correction will conclude, what it does change is our upside target for our fifth wave, because we are still looking at waves 1 and waves 5 being equal, considering that the first leg of this rally from 1,200 to 1,280 was approximately an $80 move, and given the fact that we have now seen this market track as low as 1,300, if in fact the market does find support in this area after selling off from these highs of 1,360, our upside target has been greatly reduced and has gone from 1,400 to 1,380. My recommendation is obviously we were stopped out. We will remain flat and let the dust settle, see if we can get some strong confirming indications that a base has been formed before entering the market again from the long side. We want to see if this holds, or if by chance this market will drift below 1300 to as low as 1280. I cannot foresee the market going below that. If in fact it does, it would negate the current bullish model that we have. Lastly, I do want to take a look at a dollar chart, because given that we had a strong sell-off today in the precious metals market, specifically gold, it was dollar-based for the majority of the move. And I draw your attention to a chart that I've just pulled up of the Kitco Gold Index, and we can see that spot gold, when I took this particular screen grab, was trading at $12.9930, below $1,300 per ounce. And when we break down the elements of today's sell-off, you can see that the vast majority of this $11 decline was with the dollar index causing a decline of $8.80, whereas normal selling only accounted for $2.60 of today's decline, resulting in an $11.40 decline. Traders, inasmuch as I had anticipated a correction on this current sell-off to be no deeper than 50%, I was in fact incorrect. This correction has taken us now to a 61.8% retracement, which is precisely $1,300, and the question is whether or not we created any kind of long-term chart damage. And as I spoke about during our technical studies section, based upon recent activity, we are still within acceptable parameters of a bullish model. That might not feel like that's the case given that we were stopped out today, but nonetheless, that is a fact. Traders, I always wish you good trading at the end, and I am sorry that we were unable to deliver that to you today. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow for another daily update and